Consumer confidence slipped again in the third quarter after a significant improvement in the second quarter. The FNB BER Consumer Confidence Index slipped back to a level of -1 in the third quarter of this year from a +4 index points during the second quarter. But FNB says the fact that confidence among consumers did not revert to the negative levels seen last year's, or in the indicators last year, an improved willingness among consumers to spend is likely, particularly among the higher income groups. Well, Sizwe Ngqedlana is a chief economist at FNB. He joins me now. Sizwe, as always, thanks very much for coming in.
Good afternoon.
We've seen an increase of 75 basis points with the Reserve Bank's interest rates coming up so far this year. I would have thought that these consumer confidence numbers would be much worse than they are, albeit they're still negative. But I thought it would have been worse because the interest rates are so high.
Well, the interest rates actually aren't that high. We are still near 40-year lows when it comes to interest rates. Remember, if you look at where we've come from, I mean, we had prime rates at above 15%. Before the cutting cycle began in 2008, we dropped by 700 basis points. We only up 75 basis points. So interest rates, as the Reserve Bank has said, monetary policy is still very accommodative.
All right. This index measures a lot of things. One of the things it does do is look at the consumer's willingness to buy durable goods. I would have thought that South Africans are not racing out there to buy stuff like furniture. What does the index say? Well,
the index is telling us that consumers continue to indicate that now is not a good time to buy durable goods. Remember, the Consumer Confidence Index is made up of the three questions: do households like the economy? So in other words, what's the rating of the economy over the next 12 months? What's the rating of their own finances over the next 12 months? And whether now is a good time to buy durable goods. The reason why we ask that question is because consumer confidence is also related to willingness, and to the extent that you are willing to make a big financial commitment, like buy a house or a car or furniture, it then indicates how confident you are. And so consumers continue to tell us, and this has been a consistent theme for almost 2 years now, that they don't think now is a good time to buy durable goods. They also, and I think quite obviously, don't like the prospects for the South African economy. But when you ask them about their own finances, overall, they are reasonably more optimistic or confident about their own finances.
But there's a deeper story there. I mean, there are a group that says that they are more confident, and there's a group that says, no, the economy is not working out. Just talk to us about that.
Okay, so then if we take it one step further and say consumer confidence analyzed by income bands, what you find is that higher consumer confidence amongst the high income groupings. I mean, if we say people that earn 14,000 rands a month plus, that's sort of our highest income grouping. They have much higher consumer confidence overall. And where it comes from, given the three splits of the questions, is there's a particularly strong positive confidence number when it comes to high income consumers' rating of their own finances. In contrast, low-income consumers have far lower consumer confidence, and that's because they don't like the outlook for the economy, they don't like their own finances, and they obviously don't think now is a good time to make a big financial commitment.
All right, let's just talk economic growth here. We've got consumer spending contributing the most to economic growth. What is it looking like as we approach Christmas?
Well, look, we've seen a slow puncture in domestic demand in South Africa. And I mean, we've been expecting this for quite some time. The things that drove household consumption up, which were low interest rates, those are starting to increase. It was strong government spending. The government is now financially constrained, so it has to continuously reduced growth in its spending, which means lower growth in government wages, therefore less money in people's pockets. It also means slower growth in social grants, again, less money in people's pockets. And the other thing that drove consumer spending was unsecured lending. And you've seen the private sector credit extension numbers, heading towards zero. And the unsecured lending growth is basically flat year on year. So we've seen those drivers or boosts to household consumption expenditure begin to fade quite significantly over the last, say, 2.5 to 3 years. What's happened in the first half of this year is that that's been exacerbated by the loss of income due to strikes. So if you look at the growth in overall compensation of employees, which is the national wage bill, That was moderating because of these factors that I've already alluded to, but then there was an extra moderation in the second quarter of this year that came about because of a contraction in mining compensation of employees. So the strikes have just knocked what was already a wobbly domestic demand fundamentals.
What's FNB factoring for growth this year?
1.5%.
1.5%. I mean, you ask anyone, whether it's the Treasury, World Bank, the Reserve Bank, it's just been downward ever since the end of the year last year.
Well,
where do you get the 1.5% from?
Well, we've sort of been at the bearish side of the market for quite a long time. We've called our theme adjustments and underperformance, in fact, partial adjustments and underperformance. And basically, because of these factors that I've alluded to that we expected to depress domestic demand, we've seen domestic demand growth fall from about 4% to about 2%. And what we expected was the current account deficit to narrow from about -6% to -5% to -4%. In other words, a gradual narrowing of the current account. So you've got 2% in domestic demand, plus a narrowing of the current account deficit. But because of strike activity, that export response that's supposed to be coming from mining production and manufacturing production hasn't come. So now you have a combination of a current account that stays wider than it otherwise would be and very weak domestic demand. And it gives you growth of between 1.5% and 2%.
I've got very, very little time left, but just a few seconds. You've mentioned the current account deficit. The rand's going to be hit as a result of that.
It has been.
Of course, the Reserve Bank decides on interest rates in November. I mean, do you think it's a hike in November? Because we've got to make this attractive for the foreign investors, don't we?
Yes. So look, so that's a function of the market's perception of how quickly the Fed is going to hike interest rates and whether or not we are going to see any improvement in mining and manufacturing production in our trade numbers. At the moment, I think the rand is losing the race. The only mitigation is that it doesn't seem to be rand weakness per se, but rather dollar strength. And so on a nominal effective basis, we're still strong against the euro, we're still strong against the yen, and that might cause the Reserve Bank to hold off a little bit.
All right, we're going to have to leave it there. Sizwe Ngedlana, Chief Economist at FNB. Thanks indeed for your time.
My pleasure.